Welcome back, everybody, from your non-coffee break. Time to get started again. I think we had an extraordinary first session that looked at just about every issue, ranging from the European financial crisis to the availability of funds, the availability of projects, the interest or non-interest of the Juncker plan, the need for sectoral and structural reform. So an awful lot for us to get our teeth into, and I'm very glad to have the honour of chairing this second session, which is to look at the institutional response, both public and private, to those challenges that this morning's speakers set for us. An awful lot to get through, and I do appreciate that we will be standing between you and your non-lunch. Without further ado, I'm very pleased to welcome first up to the podium Signor Gabriel Bernardino, who's chairman of the European Insurance and Occupational Pensions Authority, with responsibility for not a few euros in our own funds. So over to you. Thank you.
Thank you for the invitation to be in here. It's definitely a pleasure to be in a fantastic city like Rome and talking about these issues, which I think are really important and central right now. So it's really a pleasure to be in here. In my intervention, I will try to talk a little bit, of course, about the role of institutional investors, so being in here insurers and pension funds, and how do we see it from the perspective of the regulatory framework. Try to also look a little bit at some of the lessons that we've seen in other countries, and there's a number of countries there, you know, that there are more investments on infrastructure. Try to see what have they done and what kind of, I would say, lessons we can take from their side, and then hopefully to have some conclusions at the end. But let me start by one thing which I think is fundamental in all these discussions. We often say, and I think it's quite true, that we should have a good allocation of investments within the financial sector according to the types of liabilities that the type of the different players in the financial sector have. And it's now, I think, more and more clear that, of course, to have long-term investments, you need to have long-term liabilities. How can we have long-term liabilities? Well, if you look at the financial sector, it's definitely not on the banking side. We know, of course, the issues of the mismatching that is in there. We can have it definitely on the insurance and on the pension fund side, especially on life insurance, of course, and pension funds. But let's be frank, in order to have that, to have the institutional investors, we need also to have a focus on retirement savings. And that is something that I think it should be first priority also right now in Europe. We talk lots about having institutional investors to do this long-term investment. I think we talk less about what is happening in the different countries in the EU in relation to incentivizing private retirement-funded schemes, be it through life insurance or through pension funds. And that is something which I think it's fundamental, because it's coming on top of course, lots of changes in the first pillar of social security, because, of course, of the budget sustainability. It's needed, it's in there, it's being pushed also from the European Commission, of course, but we don't see so much, I would say, kind of a commensurate incentive at the same time to develop more private funded retirement schemes. And these are the ones that now and in the future will be able to do this kind of long-term investments. So these things are fundamental. And let me be very clear on this. I think that this needs to be part of all this element of a capital markets union also, because if we want to have the demand in there, we need to create it. And to create this demand, we need to have more reforms on the side of the retirement schemes in Europe. And it's evident that, of course, some efforts have been made, and I have seen, for example, in Italy that you've got these pension funds that have been built up. But let's also be frank that when we look around in Europe, there's an issue that needs to be confronted. Because how do we want the population, the citizens, to have more savings for retirement in a private basis if we continue with, I would say, a huge consumption part of the richness of the societies being put it on the social security systems and on first pillar. And don't wrongly interpret me. I think that at the end of the day, we need to have a complementary system with first pillar, second pillar, third pillar. That goes without saying. But when you look, for example, to the percentages of contribution to the first pillar in some countries, and you see that it's 40, 43, 45%, how can you create space for private savings and for private retirement? So there needs to be also in here, I think, the courage to see that not as a shock, but gradually these elements need to be there. So if you want to have more private retirement savings, you need gradually also to diverge some part of the contributions from a system which is a pay-as-you-go to a system which is funded. Because only by having funded systems you can have long-term investment. So this was my first point very, very clearly. Then in terms of what we see for conditions to have this long-term investment, well, definitely to have long-term liabilities, as I said. And let's be frank also, when we look at life insurance, for example, we have good part of the life insurance which maturities are short. So we really need also long-term products and long-term liabilities from the side of life insurers. And it's not only about the maturity, because if you look at it from a perspective of long-term investment, of course maturity matters, but what matters probably even equally as maturities, it's the illiquidity of the liability. If you have long-term liabilities with a long maturity, but you have policyholder options of taking out the money at all the time during the contract, you cannot do long-term investment. And that needs to be said. You know, there's no free lunch in this world, as we used to say. So I think we need to be very clear also to all of us, to the citizens, that if we really want to have long-term, retirement savings plans, that there needs to be an element of mitigating and limiting the possibilities to withdraw the money at all the time. We cannot have both things. We cannot have long-term investment and liquidity at all time. So this element in terms of the liabilities that we are creating in the life insurance, but also in the pension side, I think it's fundamental. Then another element which is also fundamental, and I've heard this morning in here, I couldn't agree more. It's about the expertise. It's about the knowledge of who invests. And again, let's be frank, of course life insurers and of course pension funds in Europe have been investing in infrastructure. You see, you look the major companies, the major pension funds, they invest in infrastructure. Probably not so much in other parts of the world, but they invest in infrastructure. They are building up capacity, they have expertise, they know how to do risk management. But that's probably only a small part of the market. When you enter into the medium and small size of the market, of insurance companies and pension funds, let's be frank, you don't have that capacity. And you can put all the plans, you can put risk charges, even negative if you want, that the investment will not happen. Because if you don't have the capacity to analyze the risks, to analyze the investments, to have a good risk management, this will not happen. So I think that there's a huge important element in here of building capacity in terms of the analysis of the projects. It's also on the supply side, I couldn't agree more, also in terms of the capacity to develop the projects, but it's also on the investor side in terms of capacity to deal with this. And let me be frank, this capacity needs to be there, because we're not talking about a free lunch. Of course, infrastructure investments, some are more risky, others less risky, but they have different risks from the ones that institutional investors are used, to get. One thing is to invest in sovereign bonds. Another thing is to invest in a pipeline somewhere or in a toll road or something which has, of course, legal risks, political risks that have greenfield construction risks, etc., etc. So this is different from the normal risk management activities of institutional investors and needs to be captured. Of course, another element that I hear all the time from the industry in relation to infrastructure investment, it's about the certainty of the regulatory environment. And regulatory environment in here not being the prudential environment, I will come back to that in a minute, but the regulatory environment, the certainty from a tax perspective, for example, from an incentives perspective, and this is something that only governments can give. And I think that this needs to be a fundamental element in these plans that we have seen right now. It's to give regulatory certainty to the investors in order to have them, of course, investing in these products. From the prudential framework, and of course I will touch on that. I think there's a couple of elements which are fundamental. Firstly, it's about the rules on investment. And let's be frank on this, I think that in Europe we have been, I think we're going in the right direction in that sense, because we're taking out from limitations on investments from the past that we had. So we're moving to a prudent person principle, where of course it's up to the companies to develop their own the investment policies according to their own liabilities, of course diversifying, etc., etc. So that's good. So taking out the limitations that exist in there, but also that's important, of course, that in the prudential systems you look at risk as risk is. And then we come to the situation and to the discussions on the banking regime, on the insurance regime, on the pensions regime, especially, of course, when you're dealing with these long-term type of liabilities and the long-term type of investments. Let me be very clear on this. We believe that what is being proposed and what is in there right now for Solvency II, for the different types of assets, it captures reasonably well the risk that we have on the different assets. And let me just mention one or two things, and because I think that this debate sometimes, in this debate there are sometimes, I would say, some elements which are not really, I would say, commensurate with the reality of the regime. Because very often what happens is that people look at the individual risk charges in each asset class, which is important, of course. When you look at equity, you have 39% risk charge. When you look at non-listed, it's 49%. So all the other risk charges. This is important. But this actually, it's not the end result of capital calculations in Solvency II, because Solvency II has diversification effects included in the regime. And when you look at from the diversification effects, of course, you know, it's not these individual risk charge that matters. It's the overall calculation, and the more you have a diversified portfolio, the less these risk charges are penalizing, if you want to use that. For example, let me give you a figure. In the last test that we made, if you add up the individual risk charges, you know, it will give you, say, 100. After diversification, and so the actual capital requirements that companies will need, it was 59% less. So please be aware that when you hear very often that this is completely penalizing investment, I think that on the basis it's not really true. And there's a number of analyses, even from market providers, even from investment firms. There's a number of analyses looking at this, looking at the marginal cost of capital, the marginal location, not at the individual risk charges. And actually they arrive at the conclusion that investments in infrastructure, investments in equity, etc., in a comparison way, if you take risk return, which is what you should do from an investment perspective, actually they are not so bad. That actually they are, I think, quite in line with the basis of risk. That said,
I've been ordered to be brutal.
I will finalize. That said, we are open, and I think we showed from an EIOPA perspective that we were quite open to analyze, to investigate. We have done it for securitizations, where we come up with this idea of separating between more quality securitizations, less quality securitizations, of course, with the risk charge differentiating in there. And we try to do the same for infrastructures. We haven't data. We heard this morning Mr. Deo saying this. We are, of course, happy, and we will do it, to analyze further. to see how can we build an infrastructure asset class that will have, I would say, some good boundaries in terms of the investments that we put in there and reflecting the risk the better that we can. It will be more granular. We are open to that. It's not because of regulatory prudential obstacles that this will not move, that's for sure. But let's also be sure on one thing. If we create incentives which are not due and aligned with the risks, then we are building not a sustainable investment in long-term investments. We are building something that will, at some point in time, have a bubble, and I think that's not what we want, definitely. So we will contribute, but let's also look at the true risks that are in there.
Thank you very much. Both talking about the risk, which I think is important, but also talking about the retirement savings element in Europe. Just in passing, I noted recently that the public sector liability in terms of retirement has recently been estimated at 30 trillion euros, which is one hell of a financing gap to close. Now very pleased to welcome to the tribune Raffaele Della Croce, who's lead manager for long-term investment projects at the OECD.
Thank you, Mr. Chairman. Vice President of the Commission, Katainen, said that the aim of the Juncker plan is to restore confidence and at the same time to connect available investment with credible policies. So what I was going to touch upon is bridging the gap between investors and the supply of opportunities, investment opportunities. My views will touch upon Europe, but actually go beyond that, because we work on OECD countries, we work more and more on G20 countries with the G20, and very similar issues are discussed as the same problems that we are facing today in Europe here. An investor view. The investor view is not just about one region, one specific country, although then it's global, although then we know the solution could be at European level or national level to be then implemented. So I'll focus first of all on the demand of long-term assets through a recent publication, large pension fund survey, which will be launched next week by the OECD, and then looking how to match this demand with the supply and the policy role. First of all, the role of institutional investors has been growing, and that's something we've been monitoring at the OECD over the last decades, up to in 2013 to 92 trillion of assets under management only in OECD countries. This is a growth relating pension funds, insurance, investment companies, something that we project also in the future if you think about systems where pension is mandatory, like in Australia, projecting high volumes, or if you think the aging population and how, for example, the Canadian pension plan is now over 200 billion of assets under management, is projecting over 2030 to be 500 billion. Emerging markets would add even more, and then it's true, as Gabriel said, that in Europe there are different trends in terms of private pension designs. So the role of the institutional investor is growing the market. What we're trying to do with this survey is trying to understand what are the drivers behind investment allocation. We surveyed approximately 10 trillion of assets under management across OECD and G20 countries. And including in this survey, there are some of the largest investors in the world, including emerging markets. Take South Africa with a fund of over 100 billion, the largest in Africa, or in Brazil, Previ, approximately 70 billion of assets under management, with a huge, of course, impact on financial markets in its own country and regional and international markets. What we see from an investor perspective, what is coming out from the survey, is that investors are trying to adapt to a challenging environment here, what was mentioned before, the macroeconomic environment, quantitative easing, the role of policymakers in driving the market, for some investors, distortive effects, fiscal issues, and the investment paralysis that investors see, the lack of investment opportunities, and the high value of the assets at the moment. So in this environment, we see emerging trends and practices. I won't go through in detail for lack of time, but just to point you to two of them. One is the change in the pension design system that we see from defined benefit to defined contribution system, linked to fiscal issues and policy decision with I mentioned before. Australia is a good case with a defined contribution system where you actually have investor pension funds, in this case, looking at illiquid assets such as infrastructure. Infrastructure is on average 5% of the allocation of these funds. And these are similar issues that the insurance industry, for example, is facing, trying to connect an illiquid asset with liquid requirements, which gets also in regulation. Another trend that we've seen is the green investment. What are the investors doing? What are the approaches taking? Well, you will see that very difficult to say that there is one approach. There are several approaches, but definitely a lot of interest from an investor perspective. What is coming out from the asset allocation, from the survey is, despite the fact there are a diverse set of investors there, is a trend in alternative asset. Private market, diversification, and correlation with the market. And this is something we've seen over the last years. And the potential is big, and changes will have an impact. Just think about the Japanese government pension fund, the second pension fund in the world, with 1.2 trillion of assets under management, just decided to go into alternative asset. And what the shift is gonna have on financial markets, not only in Japan, but internationally. The other aspect of the survey that we try to look at is infrastructure. How much is invested in infrastructure? Very little if we think about direct exposure, direct investment to infrastructure. This is something that has been limited and stable over the years, over the last years, despite the big interest and despite the talking that there is around this investment. We've seen different trends, direct investment versus external managers, different type and forms of accessing infrastructure. Debt infrastructure is something new, quite interesting to see how the market is developing. Policy implication. These are, of course, financing the real economy impact, the discussion we're having here today, from green infrastructure, credit opportunities, direct lending to the economy. There are risks at investor level, implication on risk management, governance of funds, be able to manage these kind of assets. There are risks at systemic level that the FSB, for example, is looking at. We're looking at with them in the G20 context of financial stability, just think emerging markets. And capital flows effect, and the role of regulation, the fine balance between transparency and stability of the system and the need for long-term investment. Getting into what is a policy role, I said that there is limited investment. At the same time, what is coming out on a positive note is the high and huge demand for this kind of investment. We can see in the target allocation of the investors surveyed, which is, for many of them, is actually larger than the actual investment that they have. But there are barriers. We know several barriers. We had a roundtable, an event with over 140 participants, investors, just last week in Paris. The two main points coming out, the main problems were about the stability and transparency of the system, regulatory uncertainty, the main problem coming out, and the lack of bankable projects. This comes with the risk profile of the project. From an investor perspective, ultimately they will invest if they find bankable investment opportunities with the right risk return profile they're looking for. So from a policy perspective, what is the reasoning? What's the decision to make? Well, first of all, what are the risks about investing in infrastructure? This is where we need to start from. This will be linked to the project cash flows, recognize the construction as a different profile and risk from the operational period, and decide what kind of risk we want to allocate to the private sector and what the risk the private sector wants to retain. And this is based on the ability to control this risk and the optimal allocation of these risks. Once this decision is made, and this is what the European Union, the EIB, will go through the 2,000 projects they have in the pipeline, decide which one they want to where they want to involve the private sector. Well, it's about which stakeholder, what kind of private sector you want to have, banks versus institutional investors versus the other financial institutions. And so this gets into leveraging the private sector money, the multiplier discussion happening in Europe. How do you do that? What are the instruments? And what is the role of institutions such as the EIB, but in general the World Bank, or other, to optimizing their balance sheet and leveraging private sector capital? Well, this, we're looking at the OECD, another piece of work, which is the taxonomy of instruments done in the framework of the G20. And what we're trying to do is divided in two parts. First of all, what are the instruments addressing the risks? Again, what are the risks in a project, the cash flow profile, so here would be in a revenue and repayment waterfall cash flows, typical for an infrastructure projects, and what kind of instruments can influence this risk and protect the investors. This will come with a price on a public policy side, and so it's important to know what we're actually offering, what is what we are aiming, and what it's a price for it. The second part is access to infrastructure. So this, for example, in Europe is a discussion about the LTIF, how to access this investment, which is illiquid, the scale is big, it's large, and for many small and medium investor pension fund, it's something that is impractical from a governance perspective, from an asset allocation point of view. Ultimately, what we want to do is to match supply and demand. The demand, this is what investors would like to see, what their picture of the investment opportunities. On an expected return volatility basis, what the risk return of investment opportunities they face, they have in front of them, where does infrastructure fit? This is a big question. Probably there is not one answer. Investors have different appetites. The investor that I shown before with the target allocation, you could look at some unlisted equity investment available, which will look for some kind of returns in double digits. So we're talking about, for example, new projects or in countries where the risk is higher. Sectors specific with the technological risk could be higher, versus other projects which where the risk is lower, and other kind of investors could actually risk appetite could match those kind of profile. So on the policy side, getting back to what I was saying, it's about providing a spectrum of risk opportunities to match the risk appetite, which is diverse and sophisticated on the other side. Ultimately, just touching, there is other work that the OECD is doing related to the taxonomy. Tomorrow there will be a presentation on the environment, enabling environment for investment. The optimization of the role of MDBs is something we're looking, trying to measure what are these instruments, what is the impact of the instrument, what is the cost of different MDBs, development of PPPs, infrastructure as an asset class, the lack of data, performance, benchmarking, trying to get more evidence out there. And in doing this, we are engaging the private sector. We have a network of institutional investors which is growing, and we are gathering together in different events. The last one was last week in Paris. The next one is going to be in Tokyo in March, presenting and discussing, getting the feedback and comments on the research that we are working on. For whatever answer of specific papers, there is a website, and I'm here around to respond to questions. Thank you.
Thank you, Signor Della Croce. That was a very succinct and extremely illuminating tour de l'horizon, if I may use some French, and if I may use some even more French. I'm very pleased to present Bernard Spitz, who's chairman of the FFSA, a board member of MEDEF, and as a senior insurance figure, will have a very good idea of where a lot of these funds are. Over to you.
Thank you very much. I realize I am with my colleagues one of the last obstacles between you and the lunch, so I will be quick. But, a rischio di maltrattare la vostra bella lingua, proverò ad esprimermi in italiano. L'economia francese e quella italiana devono affrontare alcune grandi sfide, tra cui una crescita statica, un debito elevato e soprattutto una disoccupazione degli giovani che proprio non è sostenibile nel tempo. Dunque c'è emergenza, ma come fare? Vogliamo la crescita. I tre motori della crescita sono il consumo, l'esportazione e l'investimento. I disavanzi vietano una ripresa dei consumi tramite i prestiti. L'esportazione, soprattutto in Francia, purtroppo non basta. Quindi l'unica soluzione in Francia come in Italia è di favorire l'investimento di lungo termine. Ciò implica due cose: ridurre la spesa pubblica a livello nazionale e a livello europeo controllare la coerenza fra la regolamentazione e le politiche nazionali di sostegno all'investimento. È la battaglia che abbiamo portato avanti in passato, francesi e italiani insieme, per adattare i vincoli prudenziali di Solvency II e quindi raggiungere un equilibrio fra la protezione finanziaria degli assicurati e il mantenimento della capacità di finanziamento dell'economia. E a questa condizione, solo a questa condizione, che il settore assicurativo potrà partecipare a grandi progetti infrastrutturali, tra cui quelli annunciati dalla Commissione europea, essenziali per la crescita della nostra zona. Perché gli assicuratori sono i leader dell'investimento a lungo termine in Europa. Parlerò della situazione in Francia, brevemente, in Italia e finalmente a livello europeo. Per quanto riguarda il caso francese, abbiamo avuto uno sforzo da 2 anni per rafforzare il ruolo degli assicuratori nell'investimento di lungo termine. Già ora, il loro ruolo nel sostegno finanziario delle aziende in Francia è considerevole. Su circa 2.000 miliardi, 1.150 miliardi di euro sono stati investiti nelle aziende alla fine del 2013. La quota investita nelle piccole e medie imprese, PMI, e nelle mid-cap ammonta a 50 miliardi di euro. Questo risponde non solo alla preoccupazione di diversificare gli investimenti, ma anche alla ricerca di rendimento per gli assicurati. Sul private equity, gli assicuratori hanno investito più di 25 miliardi di euro a fine 2013 nel capitale delle aziende non quotate. Sul mercato delle PMI e delle mid-cap, gli assicuratori francesi hanno creato in 2012 i fondi Nova e sul mercato del debito obbligazionario non quotato il fondo Novo, che ammonta a 1 miliardo di euro e rappresenta già un successo. Dunque, la Francia ha una posizione, direi, onorevole su questo mercato, ma ci tengo a precisare che queste innovazioni supponevano una condizione essenziale e questa condizione è la stabilità della tassazione sull'assicurazione vita. Questa fu minacciata qualche tempo fa, ma il governo francese ha realizzato che per una riforma delle assicurazioni sulla vita bisogna rassicurare i risparmiatori e non preoccuparli. Per quanto riguarda l'Italia, l'Italia intraprende delle iniziative piuttosto simili. Il decreto Destinazione Italia di dicembre 2013 ha consentito agli assicuratori di investire nei titoli obbligazionari del PMI, mini bonds, e direttamente nei prestiti. Questo decreto ha fornito una maggiore flessibilità nei mercati della cartolarizzazione, con lo stesso scopo di facilitare il finanziamento delle aziende e in particolare delle PMI da parte di investitori di lungo termine. Una riforma in corso riguarda anche la rinegoziazione delle scadenze dei prodotti garantiti che costituiscono la maggior parte dei contratti di assicurazione vita italiani, similmente alla riforma dei contratti Eurocroissance in Francia. Dunque, a un paio di settimane di distanze sono state adottate quasi le stesse riforme al di qua e al di là delle Alpi. Questo illustra le somiglianze che esistono tra la Francia e l'Italia. A livello europeo adesso è tempo quindi di istituire una propria politica a favore dell'investimento a lungo termine per gli assicuratori. È proprio questo il senso del piano Juncker, che è basato sostanzialmente sulla contribuzione degli investitori privati per investire nei settori chiave già sottolineato da Franco Bassanini più stamattina: rivoluzione digitale, transizione energetica, trasporti, comunicazioni, eccetera. Dei 315 miliardi di euro di investimenti, più di 250 miliardi devono essere apportati da investitori privati sotto forma di co-investimento. Gli assicuratori sono i partner naturali della politica europea dell'investimento. Con 8.500 miliardi di euro in Europa, un po' più di 2 miliardi in Francia, gli assicuratori sono i primi investitori di lungo termine in Europa, davanti ai fondi pensione e ai fondi sovrani. La loro quota aumenta anche quando le banche sono costrette a ridurre il loro bilancio. Questa è la storia di Basel III. E in questo momento che constatiamo un'incoerenza completa tra le priorità politiche e la regolamentazione economica dell'Europa. Le politiche sostengono che la priorità è l'investimento di lungo termine, le PMI, le infrastrutture. Però, nel frattempo, la regolazione penalizza cosa? L'investimento di lungo termine, le PMI, le infrastrutture. Questo non può funzionare. C'è emergenza e non possiamo più sbagliarci. Il fallimento economico, come già detto questa mattina, avrebbe ripercussioni inaccettabili e soprattutto il populismo in Europa. È per questo motivo che chiediamo che siano ridotti i requisiti patrimoniali. Abbiamo 4 domande. La prima è che siano ridotti i requisiti patrimoniali per il private equity, la cartolarizzazione e le infrastrutture. Secondo, la Commissione ha già semplificato la formula standard per alcune categorie di cartolarizzazione di migliore qualità e per il venture capital, ma questi adeguamenti non sono sufficienti. È necessario andare oltre, mirando a tutte le cartolarizzazioni di buona qualità e agli altri segmenti dell'investimento. Terzo, è urgente che le 3 istituzioni, Parlamento, Consiglio, Commissione, ritengano le calibrazioni nel testo di livello 2 che sfruttano al massimo i margini di manovra autorizzati dalla direttiva in direzione favorevole all'economia produttiva. Questo ovviamente nel rispetto del calendario dell'applicazione di Solvency II. E quarto, è necessario l'inclusione del settore finanziario nel TTIP, questo gran mercato tra gli Stati Uniti e l'Europa. In conclusione, direi che il mio messaggio è molto semplice. C'è emergenza. Come l'ha detto Bassanini, il rischio è quello del populismo in Europa. Dunque, alle istituzioni dell'Unione direi, e a Jonathan Hill, aiutateci ad aiutarvi ed ad aiutare l'Europa dell'investimento. Agli Stati, soprattutto Francia e Italia, direi, rimanete uniti per eseguire le riforme strutturali necessarie al ritorno della crescita. E rivolgendomi alla Germania, aggiungerei, dobbiamo unire le nostre forze, francesi, italiani e tedeschi, dobbiamo unirci per una dinamica europea che offrirà un futuro alle nuove generazioni. Grazie.
Grazie per questa intervenzione eccellente. I do wonder if you have any messages for the UK. I think thank you very much for highlighting a couple of central points to this debate. The first is this of emergency versus business as usual. To what extent is the patient still undergoing a heart attack on the operating table and therefore we need to be using non-conventional measures, or to what extent is the patient on the path to recovery and just needs more exercise and a better diet? And I think that that debate is preoccupying politicians, central bankers and indeed commercial bankers. I think the second important point that you raised is the balance between the necessary prudential reforms for financial stability versus applying too tight a corset that will restrict investment and economic growth. So again, what is the right balance between letting lending and credit rip and thereby recreating the kind of conditions that we saw in 2007 versus so constraining banks with capital controls and prudential regulation that they stop lending altogether, which as a couple of speakers this morning pointed out is particularly important in Europe, where something like 80% of business credit comes through banks, unlike in the States where it's the other way around. And I hope to pick up on that. We're going to hear from Federico Arceli, Senior Partner of Oliver Wyman, distinguished banking consultancy, amongst other things. So over to you, Federico.
Thank you, Philip. I have been asked to speak of a very broad argument because, of course, the role of banks in long-term credit and long-term investments may seem obvious to be the lender. Whilst today I think the situation should be eventually seen by several different perspectives, some of which you already mentioned. So the moving landscape that we have in current times, in particular the changes that are ongoing in the financial sector in terms of regulation, in terms of stringent and more stringent demands of gaining capability in terms of control, risk adverseness, and increase of need of capital. So all this is something that is changing a bit the landscape because what we see is that whilst time ago, before the crisis, the event of an expansion in monetary policy would have often converted in banks being in condition to lend more. Today we see a limit in the transmission mechanism capability to convert monetary policy in effective investments. And this is twice more valid than when we speak about long-term investment, because what we see is a clear difference between what is the approach to the short term and the long term. So I prepared a few slides to introduce what has maybe less to see with the context of investment and more of the context of what is going on. And then I will try to take from that in order to give some views, some ideas about which perspective we may eventually see for the future. So we are in the middle of a very interesting phase. Following this year's comprehensive assessment and, let's say, according to a roadmap that has been discussed and decided since some times, we will have a broad change in what is the overall scheme for regulation and supervision in Europe. Essentially, we have, since November the 4th, a single supervisory mechanism, which practically speaking means ECB taking over responsibility of supervision for about around 120 institutions in Europe. And this is a major shift because for the first time we have a global European supervisor which acts on these topics in the place of the national ones. Second, which is maybe less clear in terms of what is communicated, but in few days we will have the single resolution mechanism and in 1 year more or less from now we will start to have the funding and the phasing in of the single resolution fund. What does it mean? Clearly everything will shift little by little from a governance model which is more focused on national authorities, which has been the past, to a European system. And this means substantially, and this is the reason for which I start with this slide, that the context will change dramatically for the kind of habit that banks had till today, substantially. In practical terms, what was the ongoing attitude to business till few days ago, substantially, is trying to cope with new and stringent requirements and will bring substantially banks to be very prudent. And I would like to announce a bit my consideration about this new attitude, because the more risk adverseness come to be one of the drivers of the new activities, the more we will have a situation in which thinking to investment, and especially investing in the long term, will have to cope with a completely different kind of scenarios. So to make a quick comparison about Europe and Eurozone in particular, so not the 28, but only the Eurozone. And the other jurisdiction which have global systemic financial institutions, I think that is significant because if we consider the Eurozone as a whole, we have a dimension, financially speaking, that is very close to the one of the United States. And this situation is very different between the two markets. We have globally, Europe as more supervised, more concentrated in terms of, let's say, capability of access of funding. Essentially, as has been already said this morning, banking will have a major role in terms of what will represent the source of funding for investment. Whilst in the US, there is a concentration of major players, but there is, let's say, direct supervision focused on a lower number of institutions, which may be higher mass, which explain the difference. Eurozone clearly has still all the roots of the old system, in which there were a number of national players, which in the future, but we are speaking about a perspective trend of several years, may come to reshaping, mergers, reduction in numbers, but that will take time. So why to have done this, broad description of the situation that maybe is quite known, is on the press in a large part? Because we see Europe in a transition moment. So this transition means that the kind of attitude and appetite for long-term positioning is clearly lower. I would have one major message. Clearly, the banks would like, in a context like this, to feel more, let's say, guaranteed in order to commit for longer term investment. This kind of attitude, completely explainable by the situation and the transition, will lead necessarily to a new approach in terms of what we can imagine for the attitude that governments, institutions, and in the end the EC has tried to, let's say, cope with, not only by the Juncker plan. So essentially, we need to imagine that the future will be more and more shift from traditional banking to new form of investment, in which guarantees and other form of collection of capital resources should take the place of the pure credit. And this means that all that is done in this phase is just the first step, is an embryo step toward a new model in the financial system. Before closing, because I will try not to be too long, I will try to see what can we see as a perspective after what has been, let's say, done this year. We start from this idea of response to the comprehensive assessment, which is, in theory, a step that has been done once for all, but that will be followed by a continuing supervision by stress testing by the European authorities. Why it has been important? Because it, let's say, paved the way to create the common supervision and a common scheme and a common understanding. This level playing field that is not yet there, is not yet there not just for banks or for national schemes and economic areas, but is not yet European. So we see three main areas. Clearly, banks will need more capital. Why? Not just for the reshaping of the schemes in terms of risk, but because we know that we are already implementing Basel III, which by 2019 requires the banks to have a higher level of capitalization towards weighted assets. And so this means essentially that for a certain level of capitalization needed for allowing a certain credit today, this amount will be increased in the coming year. The leverage on the balance sheet of the banks would be lower than what it is now. What this means, practically speaking, in theory, the banking sector will be safer, in theory, but in practical terms, this triggers a number of attitudes such as reducing credit, being very careful in selecting risks, and considering carefully the revenue and the return on capital of new investment and allocation, which may, of course, change the shape of the kind of capability of banks to invest and support the economy. Second, of course, this drives also to another major and quite needed internal change, the capability of upgrade. So practically speaking, the kind of capital allocation will require much more attention to how evaluate risk weight on the asset side, much more capability to be in condition to respond properly to stress testing, which will be ongoing, and which of course cannot be seen as something that is an exercise one shot. So at this level, banks will need to stay on the market and to be considering this kind of stress testing as such as something that they do on their own. So routine. Third, NPL, which is in Italy in particular a significant issue because, of course, NPL have a significant weight on the balance sheet on the asset side, but in total terms, we have in Italy, I think if I don't remember, if I'm not wrong, about 160 billion in net, which is a significant part of the balance sheet, which will have to be managed. All over Europe, we have a problem of transfer from the balance sheet of the, let's say, the system to the eventual structures which can be, let's say, delegated to manage NPLs. And this is a whole argument that will be needed to be considered carefully in consideration of what is needed to allow banks to have free capital to invest. Without this, banks will be devoted to manage the existing non-performing positions, and we will have, of course, far less resources, technical and not in capital, to try to do new business. And, of course, this will pass through an upgrade of infrastructure and capability of management. This is what EBA, for example, suggested with the SREP framework, which will go in a very much more invasive way on the kind of management and planning that banks do. The last thing that was quite linked is the regulatory interface. Clearly, we will have an evolution of the role of national regulator. We will have a different way banks will have to interact. And we need to create, in all countries, capabilities. For example, each bank at the national level now will not have, at least the big ones, which are the bulk of the system in Europe, the national interface as the primary interface, which means essentially that as now it will be required to also provide 5 years plans, strategic plans for banks, to the regulators, this over time will mean essentially a capability to understanding better the kind of business in a very steady way banks will be able to perform in the coming years. So by a certain point of view, it's very important to cope this and to balance this with all the initiatives that are ongoing, because this means that in a way there is a predictability of what the banks may do. And it's not anymore something that goes in parallel, but there must be much more interaction between institution, European institution, and business community, financial system, in order to understand where the risk goes and where the capital may flow. Thank you very much.
Thank you, Federico. I think it is timely to remind us of the critical importance of a healthy banking system for recovery from the financial crisis in Europe. And the European Banking Union and the single supervisory mechanism is probably the most important strategic project facing the EU over the next 5 years, as indeed is the recapitalization of the European banking system. If you read between the lines of the recent ECB asset quality review and apply CRD4 now rather than awaiting transitional arrangements, you'll find that Europe's banks probably need to raise another 150 to 200 billion in capital to be fully recapitalized on current economic projections. So there are some major challenges there in revivifying Europe's banking system. I'm very, very pleased now to be able to welcome Sarah Bonesteel, who's a managing director from Prudential Financial, not only because she represents a significant amount of investable assets, but also that perhaps she can give us a little bit of a perspective from outside of Europe. So over to you, Sarah.
Thanks very much, and I'm very glad to be here today. Just to a slight introduction, I am from Prudential Financial, the American institution. It's a diversified financial institution with approximately $400 billion under management for its insurance businesses. We participate in other businesses, but my role is with the insurance company as a strategist within the insurance company. So as a little background, we have been active in infrastructure for many, many years at Prudential. And indeed, we have our own in-house asset manager who is called Prudential Capital that originates infrastructure for us. So given our size, we are able to invest directly as opposed to participate in funds. We do participate primarily as a first-order investor. Our current holdings within the insurance company, we estimate to be about $20 billion in infrastructure-related investments. And that splits approximately half and half between private and public investments. About 2 years ago, we formed a dedicated infrastructure team that's focusing on opportunities worldwide and in multiple currencies. And lastly, as far as our participation, I would say that we are participating with Raphael in the OECD's long-term investing project over the next year, and look forward to our participation there. In terms of our investment profile, as insurers, we do tend to be up in quality to ensure that we can make payments that we need to be able to make to our policyholders. And as a result, our investments are predominantly in investment grade projects and investments. Our private portfolio is, again, approximately half of our total $20 billion and divides roughly half between energy and then in non-energy type investments, transportation, social, and water investments. Our U.S. investment is primarily energy, and our non-U.S. investments are primarily again, the non-energy type investments, transportation, ports, those kinds of things. We've also been very active in public bonds in the area of Build America bonds that were referred to earlier. That was the $900 billion initiative that the Americans put into place in 2009. So our investment takes place primarily through three channels. First of all, Prudential Capital, which represents the privates, and then of course our public fixed income and alternatives group. Interestingly, our liabilities are within the insurance company are roughly half in the U.S. and half non-U.S., primarily in Asia outside of the U.S. And also, as stated earlier, our investment profile is extremely long. We have some, there are certainly liabilities in our books and in the books of many global insurers that extend well beyond the investable universe of 20 to 30 years. So seeing that, you can understand why we may be very interested in long-term investing. So I've been asked today to address whether infrastructure really is an asset class, or is it a global asset class? And I would say that although it is different from many, it does have certain characteristics that draw it together into an asset class. The first obvious one that we're all here to address today is long duration. It is long duration assets are a natural hedge to our very long-term liabilities. Infrastructure tends to be one-off and unique. Each project requires a different set of skills and disciplines to analyze, and we have to bring different areas of expertise to bear in every infrastructure project that we are evaluating. As a result, they do tend to be more complex investments, more structurally complex, that can involve concessions, guarantees, certain lender terms that make them a challenge to analyze. And they also tend to be quite illiquid. So we can have elements of these investments, such as draw periods, such as a lack of a public rating, that make them difficult for some holders to hold. And as a result, they tend to be suitable for people who have very long investment horizons. All of these characteristics come together, I think, to, if nothing else, produce an investor base that is unique relative to other investments. The need to buy long-term investments to hedge long-term liabilities and their illiquidity both make sort of draw us into the pension and insurer sector of the investor world. So why do infrastructure assets have a place in long-term investors' profiles? I mean, clearly the very long-term nature of the cash flows fit our liabilities well. The values of these investments tend to be quite stable. We like the fact that there are long-term stable revenue sources and that the credit has a tendency to improve in these projects over time as opposed to degrade. If you look historically at the recoveries on infrastructure, they do tend to be better than comparably rated corporate debt. So again, another way that we like this, that the credit quality just naturally tends to be better. Diversification and lack of correlation. These assets are, again, rather unique, and they tend to diversify us away from our home country exposure, as well as for other types of corporate credits that we naturally have on our books. And lastly, infrastructure equity we would see as quite resistant to recession and provides us a hedge against inflation as well. So from that perspective, infrastructure can be attractive. So those are all sort of the basic characteristics of infrastructure investments that tend to be interesting to us. But I think also strategically, when investors look at the other range of investments that they have at their disposal, there are uniquenesses here that we don't get in other places. For instance, if you look at the limited supply, if you look at the supply of corporate investments out beyond 20 years, there's a very limited number of investors who actually invest, or of issuers who actually issue out that long. As a result, we tend to get a little concentrated in investments, issuers that invest that issue for that long. So this does give us an opportunity to diversify. And then there's just the fundamental risk of lending to corporate borrowers over extremely long periods of time. We took a look recently to see the average age of a US company that's issuing bonds out in the world. And at the moment, if you look at that number, the average age is about 8 years, which is sort of astonishing. A lot of that has to do with M&A activity, has to do with birth of new companies that didn't exist, that did not make it into the S&P several years ago. So it's just a little indicator of how much the world can change over these very long periods of time. And given that the idea of infrastructure is quite stable relative to what we see in the corporate world. There's also a lot of other ills that can befall a corporate investor, whether it's shareholder-friendly activity, M&A activity, that sort of thing, that has a tendency to hurt bondholders over the long term. And so really few other asset classes really offer us such a diverse supply of high credit and long duration assets. Even other private lending tends to be sort of a 10 or 15-year proposal, not a 20-year plus. And so we really find this attractive from an investment proposition, and I think that's something that has not really been voiced to the same extent as the need for the investment, but there really is a need to make these two pieces fit together. So what are the obstacles and what are the challenges, and why isn't this happening now? I would say there are a couple of principal obstacles, and the obstacles that we certainly hope to involve ourselves in the conversation to help solve over time. First of all, there is the lack of legal, regulatory, political clarity around projects. To the extent that that can be alleviated, that goes a long way to solving our problems ahead of infrastructure, investing in infrastructure. As you pile on uncertainty among uncertainty among uncertainty, it gradually the load becomes too great, and we can no longer sufficiently analyze a project and determine that it's of a quality that we can invest in. And then there are other more practical barriers. The uniqueness of the projects, as I'd mentioned before. The high upfront costs that can occur just given the need to do the analysis. Lack of ratings, the illiquidity. So there are a number of challenges, but these are relatively surmountable, especially as more projects come into being and we share information about them. So what are the ways that we can address these challenges going forward? First of all, as Thierry Deo was saying earlier, it would be good to see a continued pipeline of investments, investment opportunities, which at the moment does not really seem to be there. To the extent that we can promote standardization among deals in terms of deal terms or deal documentation, that would also be extremely helpful. More transparency around how projects are performing and providing other information to a wider range of constituents so that we can benchmark and value investments and understand how these investments work in the context of a bigger portfolio. And then there is the mismatch right now between the risk and reward trade-off of the projects and what investors are really looking for. And I think a number of our previous speakers have touched on this as they've spoken about guarantees and credit tranching. We certainly can address that through structure to the and creating securitization, credit tranches, and guarantees on certain pieces of structures. That will certainly go a long way to help putting aside risks and properly evaluating and pricing projects. Other forms of guarantees. Another area related to infrastructure that we've been involved in has been export credit agency projects, where we are purchasing bonds and loans that have been guaranteed by governments that are promoting their individual countries' involvement in international infrastructure projects. That has been an interesting area for us. There might even be eventually an opportunity to create a market for bespoke credit protection on these projects, again, as the market becomes a little more standardized. And then promoting means for investors who are smaller than us and with perhaps less expertise to invest by creating pooled investments, increasing the pricing transparency around investments, and promoting more research to increase the understanding of the asset class. And lastly, I would just say on the regulatory front, the regulatory frameworks do need to acknowledge the societal need for this long-term investment and not impede good investment, quality investments by firms who understand what they're doing. So in summary, infrastructure is not only societally important, but also strategically important for long-term investors. We have certainly committed assets, resources to this asset class as a result, and I know many of our colleagues and competitors have as well. And further development of this class around more standardization and information access, as well as clarity around the legal and regulatory environment, will help infrastructure flourish and become an important element of long-term investors' portfolios. Thank you.
Thank you, Sarah. In particular, I think, for reminding us dispassionately about the requirements of international investors, particularly for legal, political and regulatory clarity when they're asked to contemplate investments that go well beyond the lives of parliaments. I'm very delighted to welcome as our next speaker Natasha Waller, who has the title of Deputy Director in a fascinating institution, the Centre d'études pour Perspective et Économie Internationale, which sounds absolutely fascinating. So I really am looking forward to hearing what you have to tell us.
Thank you. I agree the name doesn't say much, and I have to say I've joined CEPI less than a year ago from Goldman Sachs, and one of my main goals is to change the name of CEPI. But thank you. And CEPI, just to say a bit what it is a think tank in international economics. It's a research center with 40 researchers. We're within the Prime Minister's office in Paris, but we're independent politically. That's also the reason why we're able to put forward proposals that don't necessarily match the positions of the French government. So I will bring the debate closer to the Juncker sphere, but I'm very happy to speak after the representative of Prudential, because I think she made a very clear, transparent list of the criteria an international investor needs to be willing and able to invest in infrastructure, but more generally to be involved in long-term investment projects. We heard the word return, credit profile, we heard diversification, liquidity, international exposure. And I was wondering, listening to the presentation, whether Prudential would ever be willing to invest in the Juncker plan as it stands. And the next question is, would Prudential really need a Juncker plan to make its infrastructure investments? I'm putting this in a sort of provocative way because I think, this is valid for Prudential, but this is also valid for more in-between institutions like big firms that have a stake in, say, energy. Take EDF, for example. They do have investments in long-term infrastructure projects. They do issue very long bonds. And do such firms really need the Juncker plan to do what they do and what they do successfully? And this brings me to another question which has developed with me as the morning went along, and it has to do with the definition of public investment and private investment. And I think this articulation between public and private needs to be defined well before we start making prescriptions about what public investment should or should not do. Is the criterion where the money comes from? Is public investment only public because it comes from taxpayers' money? That's a very narrow definition of public investment. If you take investment made by the EIB, it's partly from taxpayers' money, but it's mostly because the EIB issues bonds, and those bonds are then invested somewhere. So where the money comes from is one criterion, but that's not the only one. It can also have to do with the public goods dimension of the investment, and that then brings us to a much broader concept of public investment, which might in fact involve a lot of private funds. But it also has to do, and that I want to relate to what Philippe was saying and what Dominique was saying, does public investment relate also to a vision that the society might have about the needs we will have in the future? Should it reflect social preferences, and if so, in which way? So having said that, I will say a few words about our thoughts and our work on the articulation between public and private investment, taking a very blunt definition, which is the definition of the national accounts, which basically looks at where the value added comes from. We've started by a set of facts, basically, the fact that we all have in mind and that have motivated the Juncker plan, meaning that private investment has really crashed with the crisis, but has not recovered in Europe while it has in the US. On this slide, you have one way to express this. You see the US versus the euro area private sector investment per capita, and you see that after the 2010 sovereign crisis, things have not gone in the right direction in Europe, while the US has really bounced back to a normal sort of cyclical development. The second fact that we've looked at is also underlying the motivation for the Juncker plan is the fact that public sector investment has gone down. That has gone down this time in both cases, in the US and in the euro area, in the same way, with the same timing. If you look over the last 30 years, which you do have on the slide here, there have been steps of reduction that happened fairly at the same time in public sector investment. We basically dropped from 4% to 2%. So that's more or less the motivation. What we wanted to understand is the complementarity between public and private sector investment. And I think that's a key question you need to answer before moving on and making prescriptions for the way the Juncker plan should be balanced. Should you only aim at private funds as it is done right now? I mean, in the Juncker plan as it stands, you have a little bit of public guarantees, but you don't have any public money. So the question is, does public money help or hinder private sector investment? Is there a timing? Is there some crowding in, crowding out? That's what we wanted to look at. In fact, that's not a new question. It's a question, when looking at the literature, you realize that a lot of people have thought about those things in the early 90s, because at that time we wanted to understand the productivity puzzle, as we called it then. You know, we wanted to understand whether productivity in the private sector was as high as in the public sector, and if not, why, etc. This literature died for 15 years, and now it's being revived again because we are where we are in terms of the data I showed you. So we looked at this complementarity using a standard macro model, which I will not develop here, and I will only give you the results that we find if the slide moves on. The first result we have is a statement on the multiplier effect of public sector investment. So it's basically telling you if and that relates to the discussion we had at the beginning. You know, we have two goals: one very short-term Keynesian goal of sustaining demand, but also a very long-term, a more long-term one of sustaining potential growth. And we do find that, or that corroborates the literature in a sense, in saying that government investment is the most powerful Keynesian tool to revive demand in the short term. That's a good thing, but there's also something we should keep in mind, and this is the dynamics of the story really matters when you look at the complementarity between public and private sector investment, and it's all summarized on that slide. That slide gives you the response of private sector investment, as defined in the national accounts, to a shock, a positive shock to public sector investment. So say, you know, the Commission decides to spend 0.5% of the budget, to spend directly 0.5% of the European budget on investment projects right now, what happens? And we have to keep in mind that in the very short term, the impact is on private sector investment is negative. So we do have a crowding out effect of the public sector investment on private sector investment. That's the bad news in the short term. But in the long term, the good news is, and you should look at the top line, which really corresponds to the top two lines correspond to the more realistic calibration of the model, that relatively quickly, with a long-term mindset, we come up with a positive impact of public sector investment on private sector investment. So you do have a complementarity between the two. This complementarity is even stronger when the initial stock of public capital is bigger. So that's a key message that is basically telling you the Juncker plan is a good idea. The Juncker plan is a good idea, yes, but at the condition that we put some public money on the table as well, and probably not only guarantees and first lost stops and the like. So, and we see we do not have any public money on the table right now, probably for good reasons. We know that, you know, national governments don't really have fiscal leeway, or at least as the, you know, accounting rules stand right now, but also more objectively for some big states, it doesn't make sense to spend more. For others, it would make sense to spend more, but they're not willing to. So we need to find that public money somewhere else. And now I want to link my statement to what has been said already earlier this morning. There are big players in the economy, in the banking sector. Those are national promotional banks. I'm putting some numbers that have been implicitly stated this morning here on the slide. I've put together the balance sheets, some summary statistics on the balance sheets of you know, the national promotional banks of the main EMU member states, Germany with KfW, France with CDC and Banque Publique d'Investissement, CDP here in Italy, and ICO in Spain. And the first line tells you the balance sheet size, you know, total assets, figures of 2012, and it's like, you know, 500 billion for KfW, 400 for CDC, 300 for CDP. That's a lot of money. That's a lot of money, and compare that to the size of the Juncker plan we have in mind, with zero money on the table. That's one key thing. The second key thing is the last line of the slide, which gives you the importance of those banks as lenders to their economy. So the last line gives you the fraction of loans made by KfW, CDC over the total outstanding loans made by MFIs, by monetary and financial institutions in the country. And you see that, in Germany, 13%, in France, 1/5 of the loans are made through CDC. Here, a bit more than 10%, same thing in Spain. So again, we have here, institutions that have a long history, that have a huge expertise, a very diversified profile. I don't want to expand too much on it because I see that my time is almost running out, but it's basically saying these institutions might be very useful in the Juncker plan as it stands now. If you remember the presentation this morning where the Juncker plan was presented, you had 3 blocks. One was the fund, which is the most commented of all things. The other one was there's a sort of list and environment. And then you had a third box where perhaps, the private sector was invited to express interest, and also national promotional banks were invited to promote, to express interest. So I really hope that they are thinking of it, and that they are thinking of it as, not only as second-order credit enhancement or only via technical assistance, but as core shareholders of the fund. The fund needs a governance that is acceptable to the private sector, and the private sector will only accept to come in if they see that the public sector is putting in some hard cash in the machinery. So I will leave it here because that would be my main message. Thank you.
Thank you, Natasha. We're particularly grateful to you for joining us today, given some of the current preoccupations in the French Prime Minister's office, where I think there are 1 or 2 policy issues currently being debated, as it were. And thank you also for reminding us of the role of the national investment banks. And I think that is the most wonderful warm-up for Eduardo Revillo, who's from the home team, senior economist at the Cassa di Depositi e Prestiti. So when he's mastered the technology, over to you, Eduardo.
Thank you very much, Philippe. And I have a good news. I'm going to try to be short. It's been a long day for everybody and a very dense program. First thing that I wanted to say is when we first started working on the concept for long-term investment was 2008-2009, when a number of promotional banks basically put together the Club of Long-Term Investors. We did not really know what we had trying to conceive and what the concept. We had the intuition there was a game changer, but we didn't know that 5-6 years after then it would have gone such a long way and become at the center of the policy of the European Union and also at the G20 with the last Petersburg meeting. Much work has been done, much thinking has been done, much official documents for the European Union, from the OECD, from the international institutions. And we see now that finance, the supply of finance is there, is ready. A couple of years ago, the institutional investors industry started moving, pension fund, insurance companies, and also other investors and funds are ready to increase their share of investment in infrastructure. Still, we need to do some few recalibration in the accounting standards in CRD4. We see that Solvency II is fine. So finance is there. Now the Juncker plan adds another important message, another important piece to the game. And now the supply side becomes the new topic that we all have to look at. So the pipeline, the quality of the pipeline. And on the large, just want to remind you that this conference will have a second day tomorrow, which is dedicated to financing social infrastructure. And I think that's very important. Infrastructure is not just TENS, TEN-T, TEN-A, broadband and large infrastructures, which do have some risks that we know, regulatory risk, political risk, and buying a concessions and in different timing, but also social infrastructure. And social infrastructure, let me say that we all said that we need investment now, and we have no time to wait much more if we need really to have an effect, okay? So social infrastructure could actually become something that can start pretty soon. I mean, we've had the experience of the new model, the 2.0 of the UK. We were talking about schools, kindergarten, public buildings, prisons, and so on and so forth. They can be standardized if they have a central agency, like it happens in the UK. If the buildings are put together in batches and bundled in larger bonds of 2-3 billion, with an availability tool, okay? And that's quite reassuring to investors because it's a 30 years leasing, and that's the idea. So that is something that investors like. There is a kind of guarantee from the local authorities that they will pay. They will pay year by year on their income statement. Of course, it's going to be a bit more expensive than doing it the old way, just with debt, with sheer debt, because the cost of funding is very low. But we have limits in the Stability Pact. So even if it's a bit more costly, the EIB recently calculated about 200 basis points more, we might get back that either in value for money or in multiplier of the infrastructure. So and this we can do, and we can start full coverage on kindergarten programs in all over Europe. Could start in 1 year time. And I think that that's something else that could get into the asset class of infrastructure asset class of the long-term institutional investors. Really what I wanted to talk about, but I will just give you a very brief hint, is we've been discussing about many topics within the long-term concept, and it took us 6 years to think about it. I hope it will take another 6 years to implement it. But 2 topics which were not very much discussed, and I think there is future research we have to do. One is the effect of corporate governance on long and short-termism, okay, and on this really compensation. Of course, if you give it to the managers, short-term compensation, they have a tendency to be short-termist. Well, actually, the literature, the empirical evidence shows that that's not really much the case. In the corporate world, in large listed markets, there is not a tendency of, the correlation is not so strong. Of course, you can do better by looking at internal models of remuneration, but if an industry is underinvesting, then it will lose on their shares, and so it has no incentives. But again, it's something that has to be the same. So the same thing has to be looked better into the corporate governance of pension funds, insurance companies, and generally other funds. Okay. Of course, if you look at the benchmark in a short term, all the times, of course, you're not. But again, if we look at the long-term part, except for government bonds, I mean, we're talking about infrastructure, and we saw the data that Raffaele showed us is only 1%. It's a very tiny part. So to increase the long-term part for long-term liabilities funds, that's something that would happen naturally. Last thing, and something that we have to think about is, not necessarily short-term investors are bad or are useless to long-term investors. So that's something that has to be thought about. It's another topic that I here propose for further research. And again, here we see 2 scenarios. Of course, if in a no-growth and deflationary environment, of course, the expected premium, the liquidity premium is lower, and it's going to be more difficult. Short-term investors have a very important role as liquidity providers, and they give information to the market. And so we cannot think that and they can help investing in also in long-term investments. And you see here, if in a high growth growth environment, the equity risk premium is going to be much better. So this is just a bit food for thought. It will take researchers in the next few months and years to work on, and in the meanwhile, I hope that we'll move on quickly with action, implementing action, and please, anybody who wants to stay tomorrow morning, the social infrastructure, I think, is a very important topic for the future of the European Union, and continental Europe really needs to invest in social infrastructure and not just in large projects and networks. Thank you very much.
Eduardo, I think you deserve a very special prize for distilling 6 years' worth of thinking into an 8-minute dissertation, so thank you very much for that. And now, by far the most difficult job of the morning, I think, falls to Signor Fabrizio Pagani, who's a very senior official in the Italian Ministry of Economy and Finance, who's going to summarize some of the conclusions from this morning for us. So over to you, Signor.
Thank you, Mr. Chairman. It's indeed quite a difficult challenge you're putting in front of me, especially given the time. And I understand I have to meet at least the 8-minute time bar.
I think we can allow you 12.
Thank you. I appreciate. Let's say that from a government standpoint, we start from a simple consideration that public investment in the future will be scarcer than in the past. This is not a question of ideology, it's just a matter of fact. This leads to two simple, as well, policy actions, if you want. We need to facilitate private investment as much as we can, first. And second, we need to make a better use of public investment. I'm not saying only of public investment in the sense of avoiding waste, but making sure that public investment has a good leverage of the private one. Looking at what we have done and what has been also mentioned in the morning, I think what has been said in this panel resonates very well with what has been done by the government. The issue of private investment is very much linked to the question of the business environment, and to facilitate a business environment which attracts investment, in which investment can thrive, including foreign investment, is one of the flagship policies of the government. It started with Destinazione Italia. In the previous government, he has a consistent policy in this government through the Competitiveness Decree and the Sblocca Italia, and lately with the budget law. How can you say that? You see that from the private investment from 3 angles, and from 3 angles we have tried to tackle it. One is the issue of widening the number of originators. Not only banks have a very important role to play, but we need to have a number which goes, actors which goes behind banks. For that reason, insurance, as mentioned by Monsieur Spitz and Mr. Bernardino and the manager from Prudential, have a very important role to play. What we have done, for example, we have allowed direct lending by investment by insurance companies. It's not an easy area, but we know that there are insurance companies which are interested to do direct lending. We have widened through a regulation of the IVAS, which is the Italian insurance regulatory authorities, the type of investment that insurance company can do in the real economy. In addition to insurance, we have also given a larger freedom and basically liberalized the credit market for credit funds. something which was not really possible before, and we've also given fiscal incentive or removed barrier to credit funds, which are now operating, and we see some first result in the Italian market. The second angle is the one of the tools that we put at the disposal of the investors. Italy has invented, if you want, this new instrument of the mini bond, which is something between the corporate bond and the private placement, and we see positive result in that sense. Of course, it's not yet penetrating very deep in the Italian economic structure, but we see companies issuing mini bonds for more than 2 billion in the last weeks and months. This is a positive sign, and with a number of successive refinement, I think we have a very good legal framework in that sense. Not only mini bond, but we also revised the framework for project bond, and we have done a number of, I wouldn't dwell on the specific, on the details, but a number of measures to bring small and medium-sized companies closer to the capital market. The Italian system, the European system is too based on banks and credits. We need to liberalize the credit market. We need to make sure that companies have the right tools, the right incentives, and they don't have barriers to access the market of capital. So in that sense, mini bonds, but also listing and getting closer to the stock market is one of the priority of what we call finance for growth. This is the second angle. There is a third angle, which is probably the most innovative, and if you look at the perimeter of where which is reached by private investment. So far, we've seen private investment, especially in countries as Italy, basically financing business. We would like to see that going deeper into the fabric of the Italian economic system. So touching infrastructure, and we see some first result in that sense through PPPs, and I'll get back to that in a second. But also in other areas, and I am very glad that tomorrow the organizer, I commend that, will look at the social infrastructure, because in that sense also the social part of it is very important. We see a role for private investment, and in the no-profit sector we see a role for private investment in the valorization and of the cultural and artistic legacy. So basically the perimeter is widening. It's not only because public investment is somehow retrenching and withdrawing, but also because through private investment, I think the tools of possibility that open up is much wider. So what's the role of private investment? Of course, there are areas which cannot be left to public investment. There are areas which cannot be left to private investment. From a certain point of view, it's not easy, but we know how to deal with public investment on one side and private on the other side. The real difficulty is when you try to match the two. This is where, the frictions becomes very high, and sometimes it becomes impossible to do project with a combination of the two. I don't know, you want to call it guarantee, you want to call it PPPs. We are working around that. We are grappling with this new challenging area of providing funding for the economy. It's really the key question which I would like to leave to this audience, which I would like to stress, because we see that from several points of view. There is definitely the private investors which have their own rules and which need to provide a return and provide certain guarantees and to have a legal framework which is certain and so on in order to have an investment, to be an investment attractive for them. On the other side, we have a public administration, and I speak particularly of this country, which is not necessarily always prepared to combine and to match the private needs. In that sense, I think some progress has been made. We are working hard with the Cassa Depositi e Prestiti, for example, on the issue of the guarantee. We are looking at strengthening the Fondo Centrale di Garanzia. We have reviewed the framework for PPPs, but I don't know. We're not yet there. I'll be very frank. I think the Juncker plan provides a good opportunity to address these issues also in terms of bottlenecks at the European level and at the national levels. It's an exercise which should be used not only to get money out of it, I think, but also to get, let's say, legal, administrative, and if you want, cultural infrastructure out of the plan. I'll stop here. Thank you.
Well, thank you very much indeed. If your advice to your minister is as precise and succinct as that, Italy is in very good hands indeed. I think as well, important to raise the issue of public-private investment. Coming from the UK, we've had a decade of experience with so-called PPI. It's highly controversial. We have not cracked the problem at all, and I would advise people to look at it. We are looking at the UK experience. Yes, but please don't copy what we did. It should serve as a primer for how not to do it, I think. A fascinating morning, a really excellent panel of speakers. We've covered a tremendous amount of ground. Before I allow you to stretch your legs and move on to the next section, which is the round table, please could I ask you to join me in thanking and applauding all of our speakers for an excellent morning. As we say in the UK, I now release you into the community. So we're on the final lap before lunch. Just to tell you, we're having a little bit of a round table here. We're down to 4 participants because we're missing the 2 ladies, unfortunately, so no diversity whatsoever here. But I thought what we'll try and do is each of our panelists will give a short 3 or 4 minutes of thoughts on what we've heard this morning, and then to ensure that you're all paying attention, we'll throw it open to questions from the floor and see if we can have a little bit of a debate before lunch. So I'm actually going to start simply in terms of geographical order. So on my far right, Richard Woolhouse from the BBA.
Thank you, Philip. I'm speaking with 2 different hats. First of all, from the perspective of the BBA, and then I want to take that hat off and talk in a purely personal capacity about some of the macroeconomic issues that we've discussed earlier today. So if you'll let me do that. First of all, I just wanted to talk a little bit about the UK infrastructure debt market. We've just done a piece of work which we're publishing in a couple of weeks on that. And it chimes with a lot of the points that were made earlier on, in particular by Thierry. There's a lot of liquidity out there for the right type of deals. What's happening in the UK is an interesting migration of talent and activity from the banks to the buy side. And you're seeing now the buy side operating in a different context. They're now doing construction phase investments without credit enhancement. So there are parts of the UK infrastructure agenda which are being addressed from that perspective. I think what the UK has done in terms of policy with IUK has actually been quite impressive. And you can see that in the recent publication, their National Infrastructure Plan, which came out a week or so ago, where they have a pretty good attempt at estimating and earmarking the pipeline. I mean, people, when you go and talk to investors, they're still very concerned about regulatory risk. They're still concerned about the long-term risks in, for example, the energy sector. But actually, there is quite a lot of certainty relative to other places about the pipeline, and I think that's worth noting. Now, that brings me on to the Juncker plan, and I'm now probably speaking less with a BBA hat. I mean, I think one way of looking at the Juncker plan is, I mean, obviously, as one of the speakers said, to welcome it, it's a good framework, but there's no new net funding in there. The targets are very ambitious, and the main point is that the pipeline is very uncertain. And the one interesting thing that I thought was not mentioned by a number of speakers is the issue of crowding out, the issue of additionality. So there's a big question here about how much of what will get proposed is actually going to happen anyway under the private sector, which again Thierry talked about. Switching back to a banking perspective, the other thing I really enjoyed was listening to Eduardo talking about short-term liquidity and long-term liquidity. I think that's a very important point. And from our perspective, there are a number of things on the regulatory agenda which could certainly be very damaging to liquidity provision. And I mean, clearly, bank structural reform is one of those. The other, you'd expect me to say, is also the FTT. But I think there are things out there which are being planned which will categorically damage the way in which the banking sector and the process of market making supports long-term investment. Finally, as I sort of touched on with the Juncker plan, I mean, basically there's no net new money on the table, which if that's the best attempt we can do at a fiscal stimulus, it's slightly worrying. I mean, I know that, for example, one thing that's been looked at by John Llewellyn, who I think is an excellent commentator in this space, who did some work, very good work in the UK, is, I mean, this issue of redefining the public accounts. So, you know, not all borrowing, not all debt's the same. Debt to fuel consumption, debt to fuel investment are completely different. And if you were able to earmark that, you know, that in the national accounts by doing it on a balance sheet basis and then essentially sell it off to the private sector later. I'm going to leave you just with a joke from Wolfgang Munschau of the FT. He says there are two types of German economists. Those that haven't read Keynes, and those that have read Keynes but didn't understand him.
Yes, German jokes are always very difficult to understand, particularly when they involve economists. So I shall now spend a long time trying to work that one out, Richard. So thank you for that. Next up, with 2 or 3 slides to get us going, is Nicolas, and I hope I pronounced this correctly, Ferzli, who is the Director General of the World Pensions Council.
Thank you, Philip. First, it's a slide that maps out 2 things. On the y-axis, you have the perceived long-term economic attractiveness of nations. So that figure is based on hundreds of inputs. Basically, these are S&Ps, Moody's, plus north of 200 investment banks, insurance companies, contributing to something called the ECR survey. It's the Euromoney country risk survey, probably the most sophisticated, deepest statistical tool we can use today. And so this is the y-axis. And then on the x-axis, you have an index that we have calculated called the Rail Transportation Infrastructure Index. It's a modified version, or RTI index. And this index is based on many variables, but to make a long story short, we focus on modern rail transportation, and we subdivide rail transportation into cost efficiency and speed components, and this is how we calculate that index. So I thought it was quite an interesting index because it shows you how the hierarchy of nations has evolved dramatically over the past 8-9 years since the start of the Great Recession. Unfortunately, and I'm French, but unfortunately Italy and France have been declining a lot if you look at the y-axis, so the perceived long-term economic attractiveness of the French nation and of the Italian nation has gone down in relative terms and in absolute terms in the past 7 years. Now, what is the ideal country, or the winners? You have the Swedish flag here on the right-hand side. So Sweden combines basically the best of both worlds. It has a high level of economic attractiveness, and its transportation transportation sophistication or advancement is quite good. There's a paradox, because if you have nations like, if you look at Luxembourg, you know, I don't know if it's like this. Yeah. No, it's Luxembourg, but I'm not sure. Anyway, the flag which is on the upper left-hand side, this is a country that is the darling of S&P, Moody's, pension funds, sovereign funds the world over, and you don't see it, but near Luxembourg, you also have Switzerland, you also have Finland and Norway, which are like viewed as ideal in terms of country risk or economic attractiveness. Many of these countries, especially Luxembourg and Canada, are very stingy when it comes to public infrastructure. So they don't spend money on public infrastructure. And yet, investors the world over tend to believe that these are rapidly growing, low-risk countries. On the other hand, France has very advanced, sophisticated public transportation, but if you look at the chart, investors seem to believe that the attractiveness of France has been going down. Now, there are many paradoxes, but I want to focus on something which is called the affluent society. So, you know, President Eisenhower was not a left-wing Marxist socialist. He was a Republican. And even though he was a Republican, he said something remarkable. Back in 1956, the US Congress was controlled by the Democrats. So that's the left, right? But even the left, even the Democrats in the 50s didn't like the notion of using public money to spend on federal infrastructure. And the business leaders, the management of Goldman Sachs, Morgan Stanley, GE, General Motors, didn't like the idea of using public money from Washington, D.C. to build highways and roads across the US. And so President Eisenhower had to spend 4 years preaching to convince business leaders from the private sector and to convince a reluctant center-left Democratic majority, and he was supposedly a Republican, a conservative. And he made a fabulous argument, and he said, our unity as a nation is sustained by easy transportation of people and goods. The cost of non-adequate infrastructure is not borne by the individual alone. It pyramids into higher expense of doing the nation's business. And so that Eisenhower perspective lasted until the late 70s. And in the early 80s, a new ideology emerged, the Reaganomics Thatcherite ideology, which lasted for 27 years. And that Reaganite thinking was very hostile to long-term public infrastructure. And I'm glad to see that in Europe, it is from London, and it is from the British Conservative Party that we're seeing now a rebirth of that long-term infrastructure-friendly ethos. And I salute our British colleagues here around the table.
Well, very rare for us to get any accolades in continental Europe whatsoever. So I thank you very, very much for that, even though I suspect the basis on which the compliments are given are a little frail. I think the Conservative Party's supposedly long-term infrastructure plans have got rather more style and substance to them, and may have something to do with the fact that we have a general election coming up in May. But put that to one side for a moment. Very pleased to welcome as our next interventionist, next speaker, Signor Dario Focarelli, who's the Director General of the Italian Association of Insurance Companies. So a lot to play with there. Over to you.
Okay, I will try to be telegraphic, and I have 5 slides in 5 minutes, so I will be brief. First of all, let me start with the question. The question is the following. Does regulation affect the ability of insurance company to invest in specific asset class? So let's look at what happened to equities. In 10 years, in the last decade, there has been a reduction in terms of asset allocation of insurance company in Europe by 11 percentage points, which means 1 trillion, because the total portfolio is 9 trillion right now, okay? Why this happened? First, it started as an internal risk management approach. Why? Because Equitable Life, a UK company, failed, having too much equities on the asset side, facing fixed guarantee returns to policyholders. So this was insane, okay? But then the process started and continuing, basically the idea was having a market consistent approach in Solvency II. There was a strong support for this, this approach, and generally speaking, this was considered an important improvement in terms of transparency. And do we still think the same? However, this is not what's going up in the US. And in the US, exactly in the same decade, nothing happened to the equity investments. So important decisions on a regulatory side have a direct effect on investments. Concerns regarding the Solvency II approach and the market consistency, there are basically two concerns, and I will not go through, here is the slide, and I will discuss a little bit on the solution which were embedded in regulation that we strongly supported. All these adjustments were made basically to avoid that temporary volatility had a direct effect on the capital position. I mean, was a sort of patchwork of measure in order to reduce the effect on the capital position. We'll see whether they will work or not. I mean, there are still concerns that they are not going to work appropriately. I hope that this is the case, because definitely I hope this is the case. But we have to address now a more fundamental issue. And the fundamental issue is the following. I mean, we need a theoretical framework in order to make it work better. Which is the one that I'm going to propose. I mean, it's a new approach to finance, which was established by Professor John Cochrane 3 years ago now, at his presidential address of the American Economic Association. I mean, everything we thought about finance has been reversed by the new data and the new methodology. There is a pattern of predictability on finance. After some years of increase in stock markets, you can predict a reduction. Obviously, this is in terms of prices relative dividends, for example. But I mean, there is a pattern contrary to the established theory of finance that finance is not predictable, stock returns are not predictable, the so-called market efficiency. I mean, this is not longer the case. And the same is valid also in other markets. Think about bonds. This is, again, John Cochrane's much variation in credit spreads over time and across firms signal returns, not default probabilities. And again, changing this approach would change completely accounting and also regulation. I mean, it's a long, very long path, but I really think that more academic research and more understanding of that would be wise to ask for. And in some sense, I think that the policy agenda will be affected by this new thinking in terms of finance market. Thank you.
Wow, well, if anything's going to make us stop and think, it's that, Senhor Early. Indeed, if you can demonstrate predictability across financial markets, at least if I could predict volatility across financial markets, I'd know what I'd be doing and it wouldn't be academic research. Sufficient food for thought there for an entire conference. But yes, thank you very much indeed for that. Our final formal speaker for the moment, and it's certainly not a question of last but not least, is Signor Fernando Navarrete, who's the Chief Financial Officer from the Instituto de Crédito Oficial, which is, I suppose, the leading or the development bank of Spain. So very grateful to listen to your observations.
Thank you, Mr. Chairman, for inviting me to this seminar. First of all, my apologies because I'm going to drag you down again into practicalities after being at the sky of pure theoretical approach. So sorry for that at the first time. So I will start with a couple of facts. I think there's been an emerging consensus throughout the session, and I'll try to elaborate upon these two facts. So fact number one, I think a lot of previous speakers have highlighted that in Europe, the fundamental problem is we have ideas but not projects. And the second fact is that this is not because of lack of funds. So the fundamental question from a political perspective, or policy perspective, is how can we transform ideas into projects? But in order to answer this very fundamental question, I'm afraid we have to answer a previous question, which is, why is it that in the current, let's say, environment, which is financial environment and policy environment, ideas do not translate into projects? And I have three elements that I think have to be considered. Of course, this is not extensive. Maybe other factors are important, but I think these three are at least very important. The first one is, I think, as an investor community and as policymakers, we're still intellectually in the old world prior to the crisis. Let me elaborate a bit on this. I think it's not just banks, investors, but also sponsors, so construction firms, people that are sponsoring projects. Indeed, we're still thinking, when we're thinking about a project finance, we're thinking about banks. It's hidden in our brains somewhere. Maybe in the UK it's less the case, but in continental Europe, we're still by default thinking this is something that has to be financed by banks somehow. And I think this is not going to work. I'm sorry, it's not, or it's going to work much less than in the past. And for very structural reasons. And it's not just capital consumption and these new capital requirements. It's more fundamental and more structural. It's net stable funding ratio. It's a full array of regulation that has emerged that is going to prevent this to be the case into the future. So a bit of paradigm shift is needed. However, having said that, it's still true that for greenfield bridge financing, banks still be critical. And I think there's been a very good presentation from an Italian colleague mentioning the importance of short-term investors for having long-term investors. So this is, again, crucial. So I'm not saying banks are not important. I'm coming from a bank. So, but the role will be different. The role of banks in project financing will be structurally different. So third, which is a bit of a conclusion of the previous 2 points, is we need to engage more with capital market-oriented long-term investors. And we've mentioned and we see people coming from this area. So we need to offer them more projects that are more suitable for them. And of course, we're thinking about pension funds and insurance companies. And I think here the Juncker plan can play a role. And I'm thinking less of the money that is presented as, let's say, as a flag. It's more about this, that it's called the technical hub or advisory hub that it is providing. Why is it that? Because this advisory hub is an opportunity for fundamentally rethinking public-private partnership, at least in continental Europe. I don't know what the case in the UK or in Anglo-Saxon context, maybe it's different. But in continental Europe, I think PPP has to be rethought for a very fundamental way. And I think standardization is a very good opportunity. Standardization in two areas. First of all, how to assess, screen, and select projects. So having a harmonization, how to apply state-of-the-art value for money tools, cost-benefit analysis, that's absolutely essential. That is basically lacking in most continental Europe countries. But secondly, also a standardization in terms of financial structuring. We need to change our mind from bankable projects, is a word we've heard, from investable projects. And it's a different thing. How to convert some cash flow into an investable project is different to convert it into a bankable project. So what do we need, honestly? And again, it's strange in continental Europe to use Anglo-Saxon examples sometimes, but I think it's good to know things that work in the world. And it's in the US, TIFIA is a very good example. What do we need in continental Europe? I think in Europe in general, is we need a European TIFIA enhanced. To be better off, TIFIA has more than 10 years, so maybe it's a bit old and it can't be enhanced. But something like that, which is, if you don't know what TIFIA is basically, it's government providing subordinated debt or subordinated guarantees that allow a project to be investable. Because we've heard that the needs of these people are different from the needs of banks. So you need this risk to be absorbed by these new type of investors. You need to do some type of credit enhancement and absorbing certain risk. And I think some presentations have been made here to address this point. So I think, and a final comment, just to finalize, and sorry for being too long, is that in this fundamental rethinking of public-private partnerships, the basic thing we have to understand is PPP can no longer be used as a way to circumvent, let's say, fiscal constraints, public debt, because in many countries, the fundamental driver for having a PPP is, okay, what is the accounting and public accounts consideration of the certain project? If this is going to be the case, sorry, it won't fly. Regardless of how much money we put in and how much financial engineering we put in there, it's not going to fly. Whether we change this fundamentally, it's not going to work. And I think, just to finalize on my pitch, I think the role of national promotional banks in this area is not just putting money, as some commentators have said before. I think we can provide some local expertise to make this fundamental change to happen. So thank you for your patience.
Thank you, very, very good. I think one of the experiences from the UK is very much the point you made, that if the driver for PPP on both sides, on both public and private, is that it's an accounting or a tax wheeze, then you run into all kinds of problems, as we are in the UK. I have to say, if anybody is still on headphones, the interpreters, who've been doing a wonderful job, now have to have their statutory lunch break. Before we all break for lunch, I just wondered, are there any questions for the panel? People are very, very hungry. I, therefore, am not going to risk trampling on your patience much longer. I would like to thank our four panelists for some excellent interventions and wish you all buon appetito. And at what time should people return? Please return eager, ready, fed and attentive at 3:30. Thank you.